Property and Casualty exam questions and answers. Welcome to the quiz. What does peril mean in property insurance? Is it A, the cause of a loss, such as fire or windstorm? Or B, the person who owns the property? C, the policy deductible? Or D, the geographic area of coverage? The answer is A. Perils are the specific causes/events that lead to property damage or loss. Named perils policies list covered ones: fire, theft. Open perils cover all unless excluded. Owner, deductible, territory unrelated. Peril is the damaging event triggering coverage. Next question. What is typically required for a surplus lines insurer to write a policy? Is it A, the risk must be declined by 3 admitted insurers? Or B, the risk must be for a very low value? C, the agent must have a special license, but no specific risk requirements? Or D, the policy must be written for a 1-year term only? The answer is A. Surplus lines, non-admitted. Insurers aren't licensed in the state, but can cover hard-to-place or unique risks through licensed surplus lines brokers when admitted. Standard insurers decline. Often, a certain number of declinations, like 3, from admitted carriers is required to prove no standard market exists. Low value isn't the issue. Agents/brokers need surplus lines authority. Term varies. Surplus lines fills gaps after admitted market rejections. Next question. What is the primary purpose of a fiduciary liability insurance policy? Is it A, to cover liability of those who manage employee benefit plans, like 401k plans, for errors or breaches of duty? Or B, to ensure the fidelity of employees? C, to cover liability of company directors? Or D, to provide liability coverage for financial advisors? The answer is A. ERISA and common law impose fiduciary duties on those administering employee benefit plans, pensions, 401k, health plans. They must act prudently, diversify, follow plan terms. Fiduciary liability insurance, ERISA fiduciary liability, covers defense and damages if they are sued for breach of those duties, e.g., poor investments, mismanagement. Employee fidelity is crime bonds. Directors are D&O. Financial advisors may have E&O. Fiduciary liability specifically protects benefit plan fiduciaries from liability for plan-related errors or breaches. Next question. What is the key difference between occurrence and claims-made liability policy forms? Is it A, occurrence responds to incidents that happen during the policy period? Claims-made responds to claims first made during the policy period? Or B, occurrence is only for auto liability, claims made is for general liability? C, occurrence policies are always more expensive? Or D, claims made policies have no need for a retroactive date? The answer is A. Occurrence covers incidents/accidents during policy period, claim anytime later. Claims made covers claims first made during policy, reported, for acts after retro date. Not type-specific. Cost varies. Retro date is key for claims made to limit prior acts. Main difference is trigger, event date versus claim date. Next question. What does Bailey coverage protect? Is it A, a business that holds property belonging to others, e.g., a dry cleaner, Or B, a business that ships its own property? C, a property owner? Or D, an employee? The answer is A. Baileys, like cleaners, repair shops, warehouses, have care/custody of customer property. Bailey coverage, often inland marine, protects against loss/damage to that property while in their possession due to covered perils. Not owned shipments, cargo, owners, or employees. Bailey covers liability/exposure for others' goods entrusted to them. Next question. In property insurance, what does the term insurance to value ITV emphasize? Is it A, the importance of insuring property close to its actual value to avoid underinsurance penalties? Or B, the requirement to insure for the full market value, including land? C, a marketing term for high-value policies? Or D, a rule that the insured value must match the tax assessment? The answer is A. Most property policies include a coinsurance clause that requires the insured to carry coverage equal to at least a certain percentage, usually 80% or 90%, of the property's full replacement cost at the time of loss. If the insurance amount is below that threshold, underinsured, the insurer applies a penalty that reduces the payment for partial losses proportionally. Insurance to value means maintaining adequate limits relative to current replacement cost so that partial claims are paid in full, minus deductible, without penalty. Market value includes non-insurable land, so it's not the target. It is not a marketing phrase. Tax assessments are unrelated to replacement cost. ITV stresses proper limit setting to avoid coinsurance reductions. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.